Hello, everyone. Thank you for the opportunity to present to you at the 2021 CARE conference. And today I want to talk about why academic research and education on sustainability accounting and reporting is of paramount importance. I will talk briefly about the research highlights, the climate risk disclosures, the regulatory landscape in the US and how it has evolved over the last decade, and some challenges and direction for future research, and then put a little bug in your ear about education on sustainability accounting and reporting and impact investing. Um, over 10 years ago, my co-authors and I set out to address a very basic question, which has to do with, are investors paying attention to sustainability data? More specifically, we looked at the valuation effects of carbon emissions. So our first paper, we used a sample of the S&P 500 firms that disclose their carbon emissions data voluntarily to the CDP. And our data range from 2006 to 2008. We found that for every additional 1,000 metric tons of carbon emissions, firm value decreases by $212,000. And you can see there the implications, an example using MPV value. But we also found, so in addition to this negative association between carbon emission levels and firm value, we also found that the firms that do not disclose their carbon emissions data to CDP voluntarily, they are penalized even further. So the median value of firms that disclose their carbon emissions is about $23 billion higher than that of the comparable non-disclosing firms. But importantly, so that study looked at greenhouse gas carbon emission, which is one of the greenhouse gas emissions. But it is important to know that observe that greenhouse gas emission is not equivalent to climate risk. Greenhouse gas emission is only one factor, but not the only factor related to climate risk. The implication of this is that companies that have relatively low greenhouse gas emissions could still face very high climate risk. So a further implication of this is that unsophisticated or uninitiated investors may be misled by companies that are not disclosing their climate risk, particularly for investors that are only putting too much weight on just the one factor, greenhouse gas emissions. Here's an example of the context of the US regulation on climate risk disclosures. So the SEC issued this comment letter to EMC Insurance Group based on their Form 10-K for December fiscal year ending December of 2011. What they're asking EMC to disclose is how the weather-related catastrophes is related to losses or has a legal, regulatory, or social response implication. So they're asking this insurance company to include this information, disclose this information in the risk factor to describe the potential effect of climate change. Fast forward to 2016, and this is what these are the disclosures that you would find by Emerson Insurance Group in the risk factor disclosure. So now they are disclosing that the company is exposed, the company's insurance operations expose the company to claims arising out of catastrophic events. So they are acknowledging these additional losses, and they are going as far as saying that the increase in the cost of reinsurance protection could materially adversely affect the company's business and or financial condition or results of operations. So this is as specific as it gets with these disclosures. In 2017, the Financial Stability Board issued a task force on climate-related financial disclosures. And what is important about this framework is that it classifies climate risk into two big buckets: transition risk, which you see the four risk on the slide, as well as physical risk. Okay, but however, this is not mandated. This is still voluntary. Coming back to the current U.S. regulation on climate risk disclosures, in 2010, the SEC issued an interpretive guidance that is not regulatory, right? It's just interpretive guidance saying that if a firm has material transition or physical risk, that they need to disclose those in their filings to the SEC. But this is still not specific enough, and with the implication of the fact that this is just guidance, not additional regulation, the implication is that just because a firm may have material risk doesn't mean that they are going to go ahead and disclose it. We know that the SEC comment letters related to climate risk are very few out of 41,000 from 2014 to May 2017. Only 14 of those letters related to climate risk. Right. So the question is, this leads to the question about, well, so now let's move from the voluntary space to the mandatory space related to climate risk disclosures. So we already mentioned that there's ambiguity about the materiality of climate risk, and also the SEC has not been very consistent in enforcing these climate risk disclosures. This takes us to my next project, Climate Risk Materiality and Firm Risk, with my co-authors Matsumura and Prakash. And the question that we are addressing here is, do managers' decisions whether to disclose climate risk in Form 10K credibly reflect whether climate risk is material to the firm? And so that's the overarching question. So we also want to find out, does the association between firm risk and disclosing climate risk in Form 10K vary depending on capital market expectations of risk materiality? So here's the framework, the conceptual framework for our study. It's at the intersection of the regulatory context, what firms are disclosing in Form 10K, and users' materiality assessments. So this acknowledges the current research on materiality, and it acknowledges the SASB materiality map that we used to operationalize expectations. So our sample firms include the S&P 500 firms from 2008 to 2016. And to our first question, we found that firm risk, which we proxy by using cost of equity, the cost of equity of the disclosing firms is 27 basis points lower than the cost of equity of the non-disclosing firms. We also found, related to the expectations, the capital market expectations of risk materiality, that when we look at the firms that are in the material climate risk category or bucket, their cost of equity is 50 basis points lower for disclosers than for non-disclosers. Also, for the firms that are in the non-material climate risk bucket, the cost of equity is 23 basis points lower for the disclosures than for the non-disclosures. So yes, there is the capital market expectation of risk materiality. Actually, it plays a significant role in risk. All right, so these are our main findings. Less than 50% of firms do not disclose any climate risk information in Form 10K. Now, notwithstanding the little regulatory enforcement of material climate risk disclosure, we find that the equity markets are actually penalizing non-disclosure, the firms that are not disclosing material climate risk in Form 10K, and the penalty is even costlier when the market expects climate risk to be material for firms that are in the material risk category. I just want to highlight that this is a great time to be doing research in this area, because due to the evolution of the U.S. the enforcement, the SEC regulation on climate risk disclosures, particularly for what has been happening in this year, the first half of this year, you can see there that there is movement from there is very interest from the SEC chair as well as the Treasury Secretary to actually make these climate risk disclosures mandatory mandatory for firms. I want to conclude by offering some challenges and direction for future research. The importance of the role of standards and regulations. There's a need for standards to harmonize corporate social responsibility disclosures or ESG disclosures. Also, it's important to look at the role of auditors and what are factors that may affect auditors' judgments regarding clients' material climate risk disclosures or lack thereof. And finally, it would be very important to look at what are investors' reactions to corporate social disclosures and performance. Are there any individual differences that may affect the investors' reactions? So and I want to emphasize the importance of also incorporating sustainability accounting and disclosure and impact investing as important topics in the business schools curricula. So thank you once again for the opportunity to share my research and some potential direction for future research with all of you. If you have any questions or would like to continue the conversation, please feel free to reach out to me at the email address you see on the screen. Thank you very much.